The chair of the International Monetary Fund says the United States is facing an increased risk of recession. Kristalina Georgieva warned that there is a narrowing path for the U.S. to avoid recession. The warning comes as the Federal Reserve introduced the biggest rise in its benchmark lending rate in nearly 30 years to tame the rallying prices. U.S. inflation is at a 4-decade high. This is squeezing American families struggling with inflated costs of fuel, food, and housing. The IMF chief also pointed to the Russia-Ukraine war and what she called the uncertainty of the current situation. She warned that further negative shocks would inevitably make the situation more difficult. To discuss that story further, I'm now joined by Jack Rasmus. He is a professor of political economy at St. Mary's College, joining us from San Francisco. Professor, welcome. It's good to have you with us. So first, I want to hear your thoughts on how the U.S. economy is doing right now, and whether you agree that sliding into recession is imminent, and if so, what are the signs?
Yes, well, it's more than imminent. I think it's a done deal. I don't think the U.S. can avoid a recession. The only question is how soon, how deep, and how long. When you raise interest rates this quickly, and we got to assume that the Fed's going to continue doing that a couple more times, 75 basis points. When you raise interest rates that fast, the historical record shows that you always fall into a recession. And that's especially true now, I think, because the U.S. economy contracted in the first quarter of this year. And the forecast by the Atlanta District Fed is that there'll be no growth in the second quarter. So, we're almost on the cusp of a recession already. And now we're raising interest rates at the pace that they indicate. I've been predicting for over 6 months now that should the Fed raise interest rates, then we're going to have a recession. The IMF is always very conservative. It's always lagging behind the actual trend in the economy, the global economy, the U.S. economy, very conservative in its forecasts. It always adjusts further when reality changes. The same with major banks in the U.S., Chase and others are all saying 50-50 possibility of a recession. Well, the business press and the banks can't say, oh, we're in a recession, because then their clients get all upset saying, you're provoking a downturn. So when they say 50-50, it really means it's better than even that we're headed for a recession. And I believe it'll happen by the end of this year, late at the end of this year, early next year at the very latest, but possibly before. Depends on, again, how fast the Fed raises rates. This is a deja vu of 1981-82 when the Fed did the same thing to deal with supply side inflation by taking it out on the backs of workers and consumers and households and destroying demand, you see. That's exactly what's going on.
And now we have the ongoing war in Ukraine. How has that exacerbated the U.S. economy? And also we have this supply chain disruptions that might as well have been a contributing factor. Tell us more about them. And also, does the U.S. at this point have any option, any way to avoid this imminent recession?
Well, I just published a couple of days ago, you can read it on my blog, jackrasmus.com, and elsewhere, an article entitled The Anatomy of Inflation. And in it, I traced the emergence of inflation, the origins of it last summer. And it was just a moderate inflation as the economy was opening up, and it was pretty stable at 5% or so for 4 months. But then when we hit the supply chain problems in late August, September, it accelerated. And then large corporations with monopolistic power began price gouging, and they're still doing that, especially oil companies. And then inflation accelerated. And then on top of that, earlier this year, of course, we have the Ukraine war and the sanctions imposed by Biden on Russia. Russia is a very important economy for commodities, global commodities, not just oil and gas. About 20-25% of global oil comes out of Russia, natural gas, a lot of it. You've got industrial metals, 20-30% of nickel and palladium and so forth for autos. And then you have agricultural commodities, wheat, 20-30% of wheat, potash, fertilizers, sunflower, the whole thing, commodities, very important commodity inflation now. Not just because of the sanctions, but because of global speculators who buy and sell these commodities in futures markets. Even before the sanctions hit, just their announcement, the speculators drove up the prices of these commodities across the board, and we're feeling the pain of that. And now the sanctions are hitting as well. So the commodity speculators will have another bite of that apple. We've got this real problem now, and inflationary expectations are now setting in, and other issues have to do with unit labor costs, pass-throughs by businesses. So inflation is going to be with us for some time here throughout the remainder of the year. Mm-hmm. Treasury Secretary Janet Yellen a few months ago said, "Oh, it's going to be temporary." But now she's eating her words and apologizing. And now she says, "Oh, it's locked in for the rest of the year." They've lost control of the thing. The Biden administration doesn't know what the hell they're doing here.
Right.
We've got a problem. And the only way to stop it, they've decided on, is to have the Federal Reserve, central bank, raise rates and precipitate a recession to take it out on the backs of consumer demand, what is really a supply side problem due to the war, due to the sanctions, due to price gouging, due to global supply chains, etc. When you step back and think about it, it's amazing with the COVID impact on the global economy and the restructuring of markets and supply chains, that the Biden administration would jump into these sanctions without really knowing what it was doing and totally exacerbate the situation.
Right.
But Biden and Democrats will pay the price in November.
Professor, I have one more question for you, and as much as I enjoy talking to you, I want you to put it as briefly as you can for this one. Let's just assume that the U.S. slides into recession by the end of the year. How will that affect the global economy?
Slow it down. How's that? Is that short enough?
No, yeah, that's just too short for an answer.
Okay. Somewhere in between. No, it'll have an impact on the global economy because it will be associated with raising of U.S. interest rates, which drives up the value of the dollar. And if the dollar goes up, other currencies go down, and that causes further stress and strain on the global economy that's already weak. Other countries have to raise their interest rates, protect their currency. That drives their economies further into recession. They got import price inflation and currency wars, and that's going on right now. I mean, the rest of the emerging markets are in a deep trouble. So is Europe and the U.S. It doesn't look like a good scenario next year.
Thank you so much. A pleasure to have you on Press TV. Jack Rasmus, a professor of political economy at St. Mary's College, joining us from San Francisco.